So I thought I'd do something different today, gentlemen. And I'm going to start my timer because instead of talking a lot about chief outsiders and stuff, I wanted to share a tool with you that we like to use for our clients when appropriate. And the simple title is Check Your Engine Oil Before Driving, because it's a way to capitalize on the unique economic business factors of your own business. I'm going to get this timer started for 10 minutes. And so it's going to be as a review for you. You guys that may have seen my presentation last year about the growth gears. It's the fundamentals that we use at Chief Outsiders, and the growth gears are pretty simple. It's all about learning, having knowledge and insight about your customers, competitors, and company, which assures you that your decisions you're going to make are going to be knowledge-based. The second gear is the strategy gear, which allows you to be effective because it starts to use strategy to feed into what you do for your markets, your offerings, and your positioning, and the basic marketing strategy, etc., which allows you to have a focused focused objectives and plans. And then finally, it leads into execution. And execution is all about being very efficient. And that's where we start to allocate resources, tactics, figure out which KPIs to measure, things like that. So it provides a very precise and accountable execution and ensures what we call the go-to-market efficiency. Now, that's Chief Outsiders. One of the assets that we use and the companies that we're aligned with is called ITR Economics. And ITR Economics, have any of you heard of ITR before?
Not me.
Because this is kind of a CEO-focused like presentation or lab, if you will. But I thought it'd be good to share with you guys, give you an idea, A, of what we do, and B, if you've got a client, and David and you in particular, and potentially Mark could use this theory that I'm going to get into here in a bit. But a little bit about ITR Economics. They're the oldest private continuous economic research and consulting firm, basically an economics firm. And the key to them is their track record since 1985. They've got a 95% accuracy rate forecasting things in the economy 4 quarters out. So i.e. when people were predicting gloom and doom at the beginning of COVID, ITR was saying, yeah, there's going to be some retraction, but it's not all the gloom and doom some other people are saying, which is why I was never as pessimistic as some were, because I had some information from ITR Economics. And what I want to share with you today is how they look at all the different economic factors. They use what they call a rate of change calculation that's based on a 3/12 monthly moving monthly total, and a 12-month moving monthly total. That's the 3 MMT and the 12 MMT you see here. You take the total of the most recent 12 and 3 months and track the rates of change compared to the prior year. So it's basic math. I'm going to go through that. It'll be a little boring and germane for a second here, but I wanted to share with you the mechanics of it, so you understand what the graphs actually mean when we get to those. So imagine you're a CEO and you've got raw data. It's monthly revenues. It could be monthly widgets sold. It could be a number of different factors. You can use whatever, but you need to have about 36 months of data. But you basically add up the 12 months to get the 12-month moving total. So can you see my pointer? See that moving around? If you add up the numbers here, they add up to 20.3. And if you add up the numbers, these 12 numbers here, they add up to 18.2. So what you're actually going for is you're looking at a way to smooth out performance that can reveal trends. So when we go to the next one, you actually start to see the moving totals and then do the rate of change here. So this 20.3 divided by the 18.2 is 11% change. That's the rate of change for the 12-month moving total. Okay, everybody follow me so far? Now the same thing can be done for the 3-month moving total. You add up the last 3 months. So these 3 numbers add up to 5.3. Again, want to have the same data set you did for the 12-month moving total. And then you do the same calculations. How's December of 19? Look at December 18. Those 3 numbers add up to 5. This is 5.3. 5.3 divided by 5. And do the math. It's 6% increase. Okay. So pretty basic so far, right? And that's the beauty about this. It's simple, but it sounds complicated. But it's the better view in the ITR Economics point of view is to look at the rate of change with these metrics. So when you do the math, you start to realize, and we're going to look at some graphs here in a second, the 3/12 rate of change tends to be a leading indicator, and then the 12/12 tends to be a lagging indicator. All right. That's the key principle of this particular concept, comparing rates of change. When you compare the 3/12 rate of change, the 12/12 rate of change, what's that look like and where is your business going? So here's our first chart. The 3/12 rate of change is the yellow line and the 12/12 rate of change is the blue line. And you'll notice that as we get into these, the 3/12 rate of change tends to lead the 12/12 rate of change by 3 to 6 months. And as an example, when the 3/12 is below the 12/12, your business is in slowing or negative growth. To take that one step further, as we look at this same chart that only goes through about 07, the 3/12, when it's above the 12/12, indicates there's going to be accelerated positive growth. And notice how the yellow line started going up here, but the blue line started going up over here. That's probably 3 or 4 months difference in that delta. I gotta look at the time.
You got plenty of time.
Okay, got about 4 minutes left. So you look for trends. So when the 3/12 dips below the 12/12, it indicates you're going to go into an area of slower growth or maybe negative growth. In this particular chart, the 3/12 bottomed out early in 09, which is this arrow here, and then the 12/12 started the recovery at this point, okay? And what's beautiful is when you see this 3/12 trending up, you know that the 12/12 should follow unless there's something funky going in your industry and your business. So that is the time to know that you should start to act, and it may be time to invest in your business because the reversal in the business cycle pattern is positive. So boom to boom, let's start investing in our business. And what they've done also is they've defined there's different phases that every business goes through. There's the blue recovery phase, there's the accelerating growth is green, and they color code some charts I'm going to share with you here in a second. Orange and then red is a recession. In this particular case, this is another plug for Chief Outsiders. I'm going to keep moving on. To give you an idea of what can happen is when you gain insights, look at the market and economy, and you can look at different categories in the economy or different parts of your business this way, you start to see what happens when, in this particular case, there is forecasted recovery and then accelerating growth in this part, and then there's going to be a change, there's going to be slowing growth and recession, and it goes on. And most businesses are cyclical that way. But the point is, what if you had an accurate forecast of growth trends for either your industry or markets or your customers' industry? And that's like talking to Chief Outsiders, but think of you guys as your customers as well. So these are the actual, so this is going to be kind of like an ITR Economics infomercial. I apologize for that. These are the things that they measure, and they provide a ITR Economics summary monthly report every month that we encourage all of our clients to subscribe to. And the executive summary by itself tends to be worth the money. So as an example, in February of 21, I didn't update this to come up to total since we were getting ready for this today, but what they do is like U.S. industrial production, the 12/12 is decreasing, the moving total is still kind of going down. So currently it's in a recession, right? But they can see ahead that in 2021 and the rest of this year, it should actually go into a accelerating growth phase. In 2022, it should go to slowing growth, and then it should return to accelerating growth in 2023. So they look at things that way and predict the economy using these factors. And the trick about this is it gives you insights, and you have to realize that everyone won't be in the same phase at the same time because there are different cycles, different seasonalities, different businesses. But the marketplace and your economy's business phase should determine how you act. So it actually gives you a 3 to 6 month head start on when you should invest, or maybe you should detract based on if you're in a slowing growth working towards a recession, that's probably the time to start saving money as opposed to spending. So from my guidelines, this is just basic stuff. It's if you know what phase you're in, you're going to understand what the trends are likely to be, and you understand whether you should invest in your business or not. So also the sage advice is that all companies do transition. Not everybody's always going up, but this gives you a chance to think ahead by about half a business cycle. And once you study this, and I've done some of this for a current client, it's pretty fascinating information. A lot of this can be learned in this book called Make Your Move. And just as the infomercial for ITR Economics, they offer it's a 30-day, oh, I didn't make the change in this one, sorry. 30-day free trial, and the 12-month subscription is now $1,100. They were giving this away for free during COVID, but now it's $1,100. So I'm going to stop share. Let's see if anybody has any questions. I read through that pretty fast, and there's my timer.
I wasn't even worried about it. We've got plenty of time. So,
Yeah, observation or question, maybe, I don't know. You know, I get all that, not in detail, but followed it. You know, with COVID, you know, obviously it was a normal cycle short of them, you know, being in Wuhan 2 years ago. So, you know, so I wonder how, you know, if the validity is, you know, slightly less than it otherwise would be in this, you know, very strange, bizarre times, you know, whatever it is, you know, inflation or supply chain challenges or whatever. In normal times, you know, you can kind of see. So do you have any insights on that?
Yeah, the client I just did has 7 different business units. So I did 7 business units and a consolidation. And as you might imagine, the basic recessionary curve trend down, the yellow crossed the blue line, et cetera, in March or April of 2020 with COVID. And then it's crossed the other way to go into aggressive growth in March or April of this year. But all 7 of their business units were not the same. They had one that's been on a steady downturn regardless of all that. It has not made the turn up. And we haven't had the conversations on what they should do to correct some of that, but great question. But I would say because of the way this tool works, it's still accurate, although for the most part, the economy is predicted to be very strong this year in the 2022, 23, at least according to ITR. So I could probably generically say everybody should invest in their business and then take into account the supply chain shortages and labor shortages and things you might have to deal with to get there. But I think the tool is still accurate, David, because it was clear to me that not all our business units were the same in the same cycle, and it's the same business, so it should have had the same seasonality.
That would make sense, Doug, because when just in general, I think when you go through all that math, right, it kind of smooths out a lot of the
Right.
up and down just by doing those, multiple levels of math.
Well, I've always done moving month averages, like 3-month and 12-month or rolling 52 weeks, whatever. But it's amazing how adapting this 3-12-12-12 rate of change to any set of data can provide some pretty key insights. And I was eager to get into it for this client that I'm working with, because it's not a new concept with Chief Outsiders, but it's new to me starting to adapt. And I just thought it was a good idea to share with you guys, whether you could use it for your clients, use it for yourself. If you have any questions, feel free to contact me, because they're not bashful about sharing the math, and we're allowed to share parts of the executive summary that comes out monthly, or the report that comes out monthly with our clients. We just can't share the whole report, as an example, because if they're not paying for it. But we've got a pretty good relationship with them, and one of our CMOs does quite a bit of work, and his 3 or 4 of his blogs have been posted on their website as well, because we do try to align, because it provides a step above just normal marketing advice and knowledge. It's, the whole business advice and knowledge.
So Doug, you put up some industries, construction and a couple other industries up there. Is that all the only industries they do, or do they do like a whole bunch?
Well, they do a whole bunch. They do the ones that tend to impact the economy and GDP the most when they're looking at the overall economy. But as an example, the most recent executive summary, they looked at the price of copper. And the price of copper is like, I don't know, $87 or whatever. And it's 87% above last year. Okay, so it looks like copper's way out of whack. Well, if you look at the trend and you look at the true pricing, copper was more expensive 4 or 5 years ago than it is today. So it's not the highest price ever, even though compared to last year, it's a big delta. And then they go on to look at a 3-12-12-12 and smooth things out and say, hey, there's not really a copper problem. They've got the same problem with copper that everybody else does. So they do look at a number of factors, and they're really smart guys.
now the use of moving averages, to track your metrics is a really proven, methodology that
Yeah.
I don't think enough people really pay attention to, but it can really help you spot, changes in the trend line quicker than if you, aren't using them.
Well, and the problem with doing just a moving average, Jim, which is what I used to do, was it was all lagging, right? The beauty of doing this moving month total versus averages and using a rate of change compared to prior year, that you're looking at the 3-month average of the 12-month total or 3-month total compared to the prior 12-month or prior 3 months. That's where the magic happens.
Right. Any other questions for Doug? No questions? Okay, Doug, I'm going to reclaim.
Thanks, guys.